The Federal Reserve just made a big move. Its first interest rate cut in years, and it's going to have ripple effects across the economy. From mortgages to savings and even the stock market, this decision impacts everyone. So what does this mean for you? Let's break it down. The Federal Reserve took a widely expected step this Wednesday, cutting interest rates by 50 basis points. This brings the federal funds rate down to a range of 4.75% to 5%. This is the first rate cut since March 2020, and the more aggressive move compared to a potential 25 basis point cut. But why now? This cut is a response to moderating inflation. The spike in inflation over the past year pushed rates up, but now as inflation cools, the Fed is aiming to keep the economy in a healthy position with solid growth and a steady labour market. Now let's get into how a rate cut actually affects you. The Fed controls the federal funds rate, which is the interest rate banks charge each other for overnight loans. But it doesn't stop there. This rate sets the tone for borrowing costs across the economy. When the Fed cuts rates, it becomes cheaper for banks to borrow, which leads to lower interest rates for consumers on everything from mortgages to car loans. But it's not just borrowing costs that are affected. Let's talk about the big sectors. Next, let's talk about car loans. Car loans are also tied to the federal funds rate, and they've become significantly more expensive over the last few years. New car loan rates hit about 8.7%, the highest they've been since 2001, but with the Fed's cut, those rates are expected to start dropping. This is also good news for anyone with variable rate student loans or credit card debt, as those interest rates should start to come down, making it a little easier to manage your payments. Rate cuts don't just help individuals, they also boost the economy overall. Companies will benefit from cheaper credit, allowing them to borrow more easily and expand their operations. Lower borrowing costs can translate into more jobs and stronger economic growth as companies invest more in their businesses. This is why lower rates are often associated with friendlier hiring environments. But it's not all good news. High-yield savings accounts and certificates of deposit have been offering great returns over the past few years. But with rates coming down, those returns will take a hit. If you've been enjoying higher returns on your savings, brace yourself. Those yields are closely tied to the federal funds rate, so as it drops, so will your savings returns. On the flip side, lower interest rates tend to benefit the stock market. With less attractive returns from government bonds, investors often turn to stocks for better returns. Historically, the S&P 500 has gained 86% of the time in the 12 months after a rate cut, which is a pretty strong trend. If you're invested in the stock market, the Fed's decision could work in your favor. So, what's next? Fed Chair Jerome Powell has indicated that this is part of a cutting cycle, meaning more rate cuts could be on the horizon. Thank you for watching. If you enjoyed this video and found it informative, please subscribe to our channel and hit the notification bell to stay updated with our latest content. Don't forget to like and share this video with your friends and family. See you in the next one.